Have you ever stopped to think about how changes in interest rates can directly affect your money, your investments, and even your financial future? While many people feel fear and remain at the mercy of government or central bank decisions, smart investors see these movements as a real goldmine. Today, you will discover exactly how to take advantage of interest rate changes to multiply your wealth, protect your investments, and even profit when most people lose. Get ready, because this might be the turning point you've been waiting for. Before we dive into the strategies, it's essential to understand what interest rates are and why they have such a big impact on the financial market. Interest rates are the price of money over time. They determine how much it costs to borrow money and how much you earn when you lend it. When the central bank raises the base interest rate, like the Selic in Brazil or the federal funds rate in the US, the cost of money increases, affecting loans, financing, and returns on many investments. On the other hand, when rates fall, money becomes cheaper, encouraging consumption, business investments, and even the stock market. This interest rate dance affects everything, from the yield on government bonds, to real estate prices, and even the value of big company stocks. Understanding this relationship is the first step to avoid being caught off guard, and to start benefiting. The financial market works in cycles. These cycles are like waves, and interest rates are one of the main forces shaping those waves. When the economy is overheating and inflation risk rises, the central bank raises interest rates to cool things down. When the economy slows down, rates fall to stimulate growth. This movement is predictable and can be monitored to make smarter decisions. Investors who understand these cycles can anticipate trends and position their investments to maximize gains and minimize losses. And believe me, you, Dan T., have to be an economics expert to spot these signs. With the right tools and knowledge, anyone can learn. Now, let us break down how interest rate changes affect different types of investments, because each reacts differently, opening up many opportunities for you. In fixed income investments, when rates rise, the price of fixed-rate bonds falls. Why? Because new bonds pay higher interest, making older ones less attractive. This might seem bad, but buying bonds at this time means getting valuable assets at lower prices and profiting when rates fall again. Active fixed income funds invest in government and corporate bonds and adjust their portfolios according to rate movements to protect capital and boost returns. Choosing these funds wisely can be the difference between profit and loss. In stocks, sectors like banks and credit companies tend to profit when rates rise because they can charge higher interest. On the other hand, companies with heavy financing may suffer. Lower rates often benefit consumer and growth companies. In real estate, higher rates make mortgage financing more expensive, reducing demand and often property prices. When rates fall, the opposite happens. Derivatives like options and futures contracts can be used to protect or leverage investments in volatile interest rate environments. Understanding these relationships is key to building a diversified portfolio ready for any scenario. Now that you know how each investment reacts to interest rate changes, here are some practical strategies to protect yourself and profit from those fluctuations. First, study economic cycles. Follow economic indicators, central bank announcements, and expert analyses to identify when rates will rise or fall. Second, diversify your portfolio. Don't put all your eggs in one basket. Mix assets with varying sensitivity to interest rates, fixed-rate bonds, floating-rate bonds, and stocks from different sectors. Third, maintain flexibility and liquidity. Keep part of your capital in assets that can be quickly sold to seize opportunities created by rate changes. Fourth, consider actively managed funds that adjust portfolios to shield against risks or seek gains during rate changes. Fifth, learn to use derivatives carefully to protect your investments or enhance returns, but always understand the risks. These techniques are used by professional investors, fund managers, and banks who move billions every day and know exactly when to act. And you can learn to do the same without needing billions. Just the right information and discipline. If you want to dive deeper and receive content like this that will change how you invest, click subscribe and hit the notification bell so you never miss a tip that can change your financial future. Let's look at some real examples to clarify things. Example 1. Fixed-rate bonds during rising rates. When the central bank announces a rate hike, fixed-rate bonds lose value, but those who buy at this time, enjoying higher interest, can sell later when rates fall, gaining both interest and bond price appreciation. Example 2. Bank stocks during rising rates. Banks earn more with higher interest rates because they charge more on loans. Investors in these stocks can benefit from price increases. Example 3. Active fixed income funds. Funds that adjust their portfolios to protect against rising rates usually perform better than passive funds. Example 4. Protection with derivatives. Investors use options to limit losses if rates rise unexpectedly. To maximize your results, always keep a long-term view, but stay alert for short-term opportunities. Continue your financial education to better understand the market. Avoid impulsive decisions. Use information to act strategically. Share this knowledge with people who also want to grow financially. The financial market might seem complex, But with knowledge and discipline, you can turn the game in your favor. Don't let interest rate fluctuations be your enemy. Use them as your ally to build wealth. If you enjoyed this video, please like, share, and comment below. I want to hear your thoughts and experiences. See you in the next Investor School video, your place to learn how to invest smartly and transform your future.